Yeah, and I really appreciate you guys joining. My name is Glenn Setchfield. I'm the VP of Marketing for DMI, and I'm just thrilled to welcome you to. I think this is our second Advanced Planning Business Roundtable, if not our third. But before we dive into the Post-Connelly information, I just want to let you know who DMI is. Briefly, we're reshaping what it means to be an independent marketing organization. So we take complex challenges and simplify them. It's as easy as that. Providing financial professionals with powerful tools, expert guidance, and hands-on support to thrive in a competitive market. With personalized service, experienced in-house marketing, and quick adaptation to industry changes, we're always here to help you turn insights into actionable strategies. And that's part of what we're doing here today as well. So, and what are we doing here today? We're going to talk about the Supreme Court's Connelly decision and how it's sent shockwaves through the traditional buy, sell, and estate planning strategies. Life insurance funding that once offered tax advantages may now trigger unexpected estate tax liabilities unless you're prepared. So during our webinar, Tom Perrone, our very own business coach with over 50 years of business owner experience, he's going to help us through the conversation. And we are further supported by the knowledge of Ed Pratesi, business valuation and transition strategies expert. His company is Valuation and Transition Strategies, LLC. It's great to have Ed back. Really appreciate you being here, Ed. And last but not least, we have Joshua Rem, one of our life VPs at DMI, back to moderate the discussion. He did a great job last time. I expect the same here again. So it's going to be a great show. As we dive into the topics, consider how this in-depth analysis can elevate your conversations and differentiate your practice, and then drive better results for your clients. Take advantage of the Q&A session today to engage directly with Josh and Tom and Ed. So there's a Q&A button at the bottom of your window that you can click into and ask questions. And at the end, Maureen will moderate some of that Q&A. Or if we catch up during the webinar, we may jump into some of those questions as well. But Josh, I'll hand it off to you to continue the conversation.
Thanks, Glenn. Yeah, we are here today to give you some information that's relevant to your practice, and also importantly is worthy of follow-up. We know you took some time out of your day and you're not here just for the entertainment value. I'm sure Tom could tell you some good jokes, but you're here because of, as Glenn mentioned, the decades worth of experience in business owner planning and valuations that are here on this roundtable. So try to listen out for things that are something you can follow up on so that we make the best use of your time today and can elevate your practice, as Glenn said. So we're going to talk about the Connelly decision. Now, this isn't breaking news. This isn't new news by any means. It's almost a year old now. But what the Connelly decision did do is it did shed some light on some important issues that should always be front of mind for anybody who has business owner clients. So that's what we're going to unpack today. And if it's gone on the back burner, we want to bring it back to the front of your mind so that we know how to have good conversations with business owners, particularly today as it relates to buy-sell. So let's get right into it. Let's start off, Tom. The Connelly decision had a lot to do with buy-sells. So what is a buy-sell agreement and why is it so important?
Well, that's the contract between equity owners of a company, which allows the purchase and sale of their shares. And it's a contract, a legal contract that says, I own some shares here, you own some shares. If I die, if I become disabled, if I retire, if I walk out, if I get divorced, if I go bankrupt, if I just want to leave, if you want to kick me out, the rules of engagement are in that agreement. Okay, that's part one. Part two is how are you going to fund the agreement? But I can't stress enough, it is a legal and binding document.
Good.
Okay.
Good. So it's a legal and binding document, and it's funded one way or another, oftentimes with life insurance. So then, how did the Supreme Court decision, which was really back in June of 2024, how did it shake up this legal and binding agreement, this buy-sell agreement process?
Since I was been in practice since 1970, we were always told that when you had a stock redemption, which is where the company's redeeming the stock at, let's say, death in this particular case, that there was an offset. Life insurance came in, but then life insurance went out on that agreement to buy the stock. So it never really changed the value because it was an offsetting, I'll call it a liability or obligation. Well, in Connelly, the difference was they included the life insurance in the estate, or in the estate, and I'm sorry, life insurance in the value of the company, which increased the estate. But they did not give the offset of the payout, okay, the obligation. And that was one of the main things in that ruling, was that there was no offset. And that threw everybody off. So if you have a stock redemption where the company owns the life insurance on the owner or the equity owner and dies, it bloats the value of the company, but there's no offset. So consequently, it becomes an estate tax issue in that particular case. So that very foreign to the way we all have been raised utilizing a cross purchase. And now we have to rethink how we're going to.
Yep.
And Ed will agree with me. We're not saying cross purchases are out, and that if you review your clients and they have a cross purchase, you should throw it out. We're not saying that, but you should review, and we'll talk more about what to do with that.
Yeah, it's
if I could add a couple of points on the case itself. It's sort of intriguing because here you had two brothers that had a buy-sell agreement, and the buy-sell agreement was, when it initiated, was probably a fairly reasonable buy-sell agreement, assuming that they did one thing, and that is follow it. The court really criticized, well, at every level, they criticized the fact that, number one, while there was initial indication of value or a certificate of value, there was no follow-up. According to the agreement, there should be at least a follow-up every year. That did not occur. Absent the certificate of value, and this is an important, certificate of value just means indication what the value is as of a point in time. What's really important here is there was a second provision in the agreement, and that is two appraisals. If you don't agree on the certificate of value, i.e. the value that you indicate as of the next year or the following year, there's two appraisals. Well, guess what? The court said, if you're not going to follow the agreement, we're not. So that's really the lesson, I think, here. If you set an agreement, make sure, number one, we won't get into the specifics of agreements, but one of the important things is ensure that you follow the agreement to the letter. And valuation is really a key point. And Tom, you're right. One of the things that we were taught always, there was always the offset. Whatever life insurance came in, it's an in and an out. Well, this turned that upside down, to put it mildly. One last fact on this, when the estate tax return was filed, no valuation was done. And while the court didn't discuss one of my favorite topics, right, 2703, which is, we won't get into that, about buy-sell agreements and the IRS saying, you listen, certain agreements between related parties have limitations and should appear this way. Absent that, there's no valuation either. So that becomes really problematic, and the court really it's a narrow view. And I think, Tom, you and I agree that there's going to be future cases in this. And we'll find that there is, and in fact, the Supreme Court, in a memo at the bottom of at one of the footnotes, indicated it doesn't mean that forever that a liability does not exist. If there is a chance where operating assets are going to be used to fund the buyout, clearly there is an offset. So that sort of opens the door, if you will. Make sure the first is make sure you follow your agreement, and second, make sure you have a binding obligation to pay it.
Very interesting. Yeah, it's true. Even, the average person who has no knowledge of insurance or buy-sell agreements, if I got this asset, but I'm required to use that asset to address this liability, the average person would say that that offsets. But according to the Supreme Court, it doesn't. So that set an interesting precedent, has a lot of implications. I like the point about, hey, this is a legal contract, like Tom said, so you better follow it. If you don't follow it, why should the Supreme Court follow it? Right. So we got to make sure we live up to that agreement. But throughout, even if you read through the Supreme Court's decision, and in everything you guys have said thus far, what this keeps coming back to at the base of this all is valuations. So how important are valuations truly when it comes to buy-sell agreements?
Wow. What an open-ended question.
Yeah.
Let's put it this way. Valuation drives the essence of the agreement. When you think about it for a moment, it's the exit. Now, there may be different ways of exit, as we'll talk about triggers at some point in this presentation. But under each of those triggers, there may be different values. And that's really important because, and also what's really important then is a stipulation as to what is the definition of value. In most cases, it's going to be fair market value. In other cases, it might be other jurisdictional values. But for the most part, if we're talking estate planning, fair market value. So if that's the definition of value, what is the next step? Level of value. Okay, what does that mean? Well, it just means one thing. We know one thing, in a minority interest, as an example, in a closely held entity, we know that a minority interest lacks control. There's a discount associated with that. How do you address that in the valuation? How do you address that in the BSA? I'll use the abbreviation of BSA for this purpose. Second, there's another part of closely held entities, and that is marketability. Well, guess what? I can't take any stock that I own in my company and sell it to you easily. Like, again, what I always used to use the analogy of IBM stock. I can't do that.
And when you say closely held entities, can you just explain that really quick?
I'm sorry?
What do you mean by a closely held entity?
Oh, I'm sorry. Privately owned entity. I'm sorry.
Yeah,
I'm using lingo.
So, no, that's fine.
Basically a privately owned entity, LLC, S Corp, C Corp, partnership, basically any entities that are privately owned, not publicly owned.
Good.
So that's the distinction. The other issue is level of values really goes back to control and marketability. You don't have marketability issues, so that's an important issue to address or not address in the. Finally, there's the qualifications of the appraiser. Vis-a-vis, does that person have the experience? And sometimes you may want to even stipulate to who that appraiser should be. And then finally, what professional standards will they follow? Typically under USPAP and other appraisal credentialing organizations, they'll follow what the IRS wants.
Nice. And we'll talk a little later about how to get in front of these business owners or how to start conversations. But here's one thing that's interesting, might help. In your experience, Ed, how many of these business owners even know what their valuation is, or how accurate are they if they say they know?
I'm going to piggyback on that by saying very few do know, and what they think they know, they don't. And most of the time, and Tom, you may agree with this as well, or in your experience, they think it's worth a lot more than what it is. And its value to whom is really the question I always ask when I get into it with a business owner. Who's the value to? Is it to you, or is it to somebody that's going to buy? And that's the leading question. But the piggyback is, I forgot the next point I was going to make. Whatever, I forgot the next point I was going to make. Go ahead.
That's good. That was good enough. Is that your experience too, Tom?
Yeah, Ed's got a good saying. You hear business owners say, well, my industry says we're 6 times or 6 multiple. And Ed says, well, that's called a rule of thumb. And if you think about it, nobody's a rule of thumb. Nobody's an average.
Well, you know what rule of thumb, if you use the abbreviation, is ROT. So guess what? There it is.
And the consideration is that, keep in mind, when you death and file your state tax return, in most cases, and I think the IRS wants a certified valuation of the company, don't they?
Absolutely. It's absolutely required. There's two provisions in the Pension Protection Act, I have to get technical, that require a qualified appraisal and performed by a qualified appraiser.
Yeah, and I might add, if you listed the cases that have gone in front of the IRS as to the owner says this is the value versus what the IRS says, I think you would find a lot of cases where they're arguing with you, and now you're making your client very famous, and maybe in tax court if it gets that high. But the
Right.
point, that's a lot of money, of course. So you're better off spending the money on getting an evaluation or some part of that every couple of years, and do yourself a favor if you own a business.
There's an additional value of doing valuation. And when we go to do valuations for estate planning, notably, we realize one thing, that if you continue doing evaluations, it really monitors the value creation or value destruction process. And if we do our job right, we can actually assist the business owner in determining how do I increase value.
That's good stuff. So it sounds like, any way you slice it, a business, a buy-sell agreement is important, but it better be airtight from the standpoint of you're following through on the stipulations of the buy-sell agreement, so as not to give the court any cause to invalidate it. And then also the valuations have to be strong. So let's assume we got our valuations correct. Now the type of buy-sell agreement, it looks like the issue, Tom, if I'm not mistaken, is the type of buy-sell agreement was part of the problem. At least it was an entity purchase, and that might have been the issue. I could be wrong. You can explain more. So what was the issue in that case? And can you expound on the types of buy-sell agreements that are out there?
The issue really was bad facts, no follow-up, and it really wasn't the buy and sell agreement. They've been doing that for many years. It had to do with the facts of the case and a bad ruling, really. But the other part of that was trying to define if was there an obligation. But I think what the bottom line is, Josh, because Connelly's good, but now it's all getting boring. And I think now we have to move on to what do we work with Connelly. Okay, so here's the deal as an advisor. I'll bottom line it for you. Okay, we won't use buy and sell redemptions at this point unless we really know that it's solidified in what we're going to do. And so I wouldn't throw redemptions out, and I'll tell you why. So I read somewhere when someone said, well, go and look at all the buy and sell agreements and review them. Yes, do that, but don't do it with the idea that you have to trash them and rewrite them. They could be very good, because remember, it still came down to an estate tax issue. So if you have a small company, $4 or $5 million, and you still have $25 million worth of exemption credits, who cares if it's in your estate? Do the right thing and keep it that way. Plus, you got to be careful, because if you start moving these policies around, you could be creating a tax trap, transfer for value problems, and also attribution if you keep it. And I'll go over that in a little while, but you can be developing some tax traps if you set it up the wrong way. So my point being, at this point of the game, take a look at the facts. I still think you could write a buy and sell agreement under an entity plan, depending on the size of the state. Let's assume it's a smaller state. I have no problem writing an entity plan if that's the easiest way. However, the positive part of this is that the creativity has come out, and I'm seeing through split endorsement and insurance LLCs, a better way of setting up the buy and sell agreement, even better than the entity, because I get more benefits, such as stepped up cost basis, and I don't taint the transfer for value, and I won't taint an attribution problem, which are all income tax problems. So anyway, so it was good that we had Connelly. Now we're moving forward to rewrite some of the buy and sell agreements the right way, maybe.
Hey, Tom, I got a question for you. I like the idea of the limited liability companies, insurance LLC, basically.
Yeah.
Do you see any problems with the funding of the insurance product inside the LLC at all?
No, because first of all, if you have a non-adverse manager of the LLC, not any of the partners,
right.
So there's no ownership, it's the LLC, the manager, buying the life insurance on each person. So if I have 3 people, I buy life insurance on each person, okay? And then upon the death of a person, it's dispersed to the manager. They buy the shares out and redeem of the primary business, not the LLC. But in the agreement, which is the primary business, they do discuss the termination of the LLC, insurance LLC. And now you have two people left that have life insurance on their own lives, and if they walk out of the LLC, they can take the distribution in the form of a life insurance policy, no transfer for value, right? So there's some real good reasons why that insurance LLC could be a nice remedy for a buy and sell agreement.
And to be clear, when we're talking about types of buy-sell agreements, what we're talking really about is who or what owns the life insurance that's funding the buy-sell agreement, who's the beneficiary of the life insurance policy. So in an entity purchase or a stock redemption, that would be the business or the corporation itself that owns it and is the beneficiary. They would receive those funds. So that's what we're talking about when structuring life insurance: who owns it, who's the beneficiary, and the implications that come along with that. So entity purchases are not out the window. Are there any other options that might be a little cleaner and less to worry about?
Well, let's look at it. You have the life insurance LLC I just talked. I think that's a very clean one. You have the cross endorsement split dollar plan. That's another good one. That's where if Ed and I are partners, we can buy our own insurance policies. We own it. Okay. I can endorse part of my death benefit of my policy to Ed, where he named his own beneficiary. And he pays a Table 1 or the 2010 Table 1 charge for that insurance. And if I die, he gets that insurance. He uses that insurance tax-free to buy the stock I own, and he owns it. And now we have a life insurance policy on his life that he owns that might have been endorsed to me on a cross basis. Well, that terminates. So Ed now can walk away with his policy intact. He's got the values of it. No transfer for value. He's got a stepped up cost basis in the new stock that he bought. So that's a clean way of doing it. And that's called a cross endorsement. I like that too. The one I get a little fuzzy about, and it's only because transfer for value, is the trustee owned life insurance, where it's like the LLC, but it's a trustee arrangement. I think there's transfer for value problems when one dies, and now the survivors who own interest in the other policies under the trust. I think that could be a transfer for value, which means the death benefits could be taxable over and above the cost basis as income tax. And then you have the normal buy and sell agreement, and you have partnerships too, by the way. That I'm not too bad with. But then you have the normal cross purchase. Ed and I buy insurance on each other.
Right.
Now, I'm 20 years older than Ed, so he's got to spend more money on me. So that gets a little pissy-oony, the kind of thing. So sometimes it's better to have the LLC just have a bunch of money come in, and you could work around that inequitable cost of premium rather than a cross purchase A to B. That thing.
Josh, I've got a recommendation here. Tom, I like all of those ideas. And in fact, as part of the planning process, in many cases, private company owners own the real estate as well. Mm-hmm. Could that or should that be a part of this planning process, including the funding of the life insurance to cover that asset as well?
Yeah, I think you could. I could. Yeah, I think you could. I think it all comes down to the agreement, what's being covered. And I mean, the two parts of it is, if I die, is there enough principal coming in to buy all these interests? Okay. Right. And the second part is make sure there's no tax trap on this buy and sell agreement. And then what happens to the survivor and those policies? Paul Hood has a wonderful checkoff list on his website that he spent a lot of time putting together, but he's done more he's read more buy and sell agreements than anybody in the country, I think. And I use it all the time. And those are kind of the questions you ask yourself when you go down and do this planning. But the answer is yes, I believe you could.
Yeah, and check off list and questions like that are one of those things that's definitely worth following up on with us, so we can get something like that in your hands. But there's all different types of buy-sell agreements. I think the cross-purchase one is the one that most advisors are familiar with and the one they would lead with, which could be fine. But I think based on this conversation, we have to be careful. We have to be careful doing what's right based on the business owner that's sitting across the table from you. So just a couple more things to touch on, and then we'll open it up to questions. I have a CPA friend. I don't really do business with him. I don't do business with friends that are too close. It just gets messy. But one thing he always says when I bring up buy-sell agreements is, Josh, you don't need life insurance to fund a buy-sell agreement. What are the other ways? Because the advisors might get that pushback too.
Well, your CPA friend says you don't need life insurance to fund the buy and sell agreement.
He swears up and down. He says there's other ways to fund it.
So
what are those other ways, and what are the
what other ways?
Yeah, because the advisors might hear that. I got a buy-sell agreement. My accountant, my CPA is telling me there's other ways to fund the buy-sell agreement. Is that true?
It's true, but it's not logical. Remember, anytime you don't use life insurance, you're talking $1 plus. With life insurance, you're talking pennies on a dollar. So let's take a look at the 4 ways of doing it, because there's only 4 ways of doing it. One, you start putting away money every year to fund a future. Well, there's a couple of things here. If I die too soon, I don't have enough money. Secondly, I just took money out of my operating system to buy inventory and turn it. And so it's basically like a bank account that's being used for nothing. Number 2, loan. I have to go to the bank because Ed just died, and I got to go out and get $1 million or $2 million. Now, my key guy just died. So he's worth something. That's why he's a partner. So do you think a banker is going to go out and say, yeah, you guys can, we'll give you $1 million, even though half of your company just got decimated by a death? Very hard to do. Thirdly, that was a loan. The third part is life insurance. And when you take a look at what life insurance costs compared to the other options, it's penny. It literally is. I've done enough of these. I never have that problem with the CPA, because he's got to give me 3 other choices that doesn't measure up. And any business owner is not going to tie up his money for a future date that might not happen. Why would he do that? He also believes me when I say the banker's not going to give you money. They don't give you money.
That's good. No, I just thought that was important because they might argue that there are other ways to fund it.
I have a video. I have a video, Josh, and you know about what I call "What's the Right Insurance Plan?" And I go through that, and I always say to CPAs, owning term insurance is like wetting the bed. At some point, you got to get up and change the sheets, because the premiums get so high, even before your mortality, you have to drop the term insurance. So what kind of advisor are you when the guy's 60 years old and he's got to drop his term insurance because he can't afford the increasing premium? That's why you have to look at all types of insurance when you look at a buy and sell funding.
Good stuff. Hey, Maureen, Glenn, we're about a half hour in. We've been doing all the talking. I just didn't know if there were any questions at this point we could field before we go on to any concluding questions or points.
Thank you. There actually are, and it's wonderful. We touched on what we were just talking about. What types of insurance can be used for buy-sell agreements? I know we just talked about different ways to fund a buy-sell, but is there a particular type of insurance that we're talking about?
Well, it depends on the situation. I've been around long enough. I honestly could say this and really mean it. I've been around long enough that if I bought a 20-year term plan in 1970, I'd be going into my 3rd renewal. Okay? That's how old I am. check my heart. I think it's so my point is that when you see a business owner, don't automatically think the cheapest plan is the one that works, because you're going to be putting them and you in a bad situation. Because any business owner going into business doesn't say, well, this business will last 3 years and I'm out of it. In most cases, they're going in long term. So I like to give them options, but most of our buy and sell agreements are some form of permanent life insurance, because they're not buying in that the cheapest is the best. And I make a good point of saying that, you know, you've got to show good financials with life insurance, because you're going to be borrowing a lot of money. And if they can afford the cash flow, fine. If they can't, it's always a temporary thing with term insurance. So there's no real answer to that. But I have to tell you that I see too many advisors knee-jerking to term insurance right away. And I don't think that's the way to go. I think you have to look at both of them and let the client make the decision.
I love that answer. Excuse me. My next question, you were touching on multiple owners for insurance. So if there are three different entities or people listed on a life contract, what are the tax implications of that, either personally or for the business?
Well, first of all, if you take a stock redemption or an entity, the corporation or the entity owns the policy, and upon death of any of the owners, it's payable to the company. They complete the transaction with the decedent's family. The stock is retired. Okay. Then you have cross purchase, where each owner owns insurance on the other. Now, if you have 3 people, that means you need 6 policies. This is where it gets cross purchase has big advantages from increasing cost basis at death and to owning the policy, but it has a downside administratively, because you need so many policies. And that's why what has grown from a lot of reasons are these LLCs, these trustees, these partnerships where you buy the policy on each person. So I don't need 6, I can use 1. Does that answer it for you? And if you do that, you're in good shape. Now, tax problems are caused because the insurance is set up the wrong way. And the 2 key tax problems are transfer for value and basically setting up a stock redemption when there's something called attribution, where there's I own a company, I own 90% of it, my son owns 10% of it. I die, and the company is going to redeem my stock, right? But they have to redeem all of it, and my son's attributable to owning some. So they didn't redeem all of it, all right? Because I'm attributable to that. So I need to sign a waiver of attribution and stay out of the company for the next number of years. And this is not an insurance company, insurance agent's issue. It's just something that they should know. So when they have a conversation with the accountant and the attorney, they make sure attribution isn't part of what's going on here. Because it could taint not the policy, but it can taint the distribution and not treat it as capital gains, but treat it as dividend.
Oh.
Okay, a little deeper, but
That was a good question. Very good question.
Yep.
So Josh, I just sent you a note. If you could look at the second question in the Q&A, and while you're looking at that, I do have one more for Tom and Ed. Can the life insurance policy for a buy-sell also be used as a retirement benefit, or should that be structured completely separately?
yes, it can, if it's set up properly.
Mm-hmm.
I talked about these entities where the insured owns the policy, or the entity like the LLC owns it on the insured, okay, and they can distribute that, or a cross purchase where I own it on Ed, and that we dissolve the buy and sell, and Ed allows me to have my policy. I can buy my policy because I'm the insured, and he was the owner. There's no transfer for value because it's coming back to the insured, so it's not tainted. So I do have a question that when we get back to evaluation, I have to ask Ed. When we get to that again, Josh. So, Maureen, so that's the deal on the insurance.
Okay, thank you.
Well, the second question, are you referring to the question on premium financing?
No.
Maureen?
No.
All right, I think I lost the order of questions, so I don't know what second
Okay,
one
I'm
you're
sorry. So
referring
let
to.
me ask the question and let me know if this makes sense. Can an insurance LLC change owners over time? A very young 10% owner to be insured, older majority owners with intern of transferring to a 25-year-old child as succession plan.
Did you follow that, Ed?
No.
Okay. So it's an anonymous attendee. If you would like,
companies, I gotta take no.
We'd love to answer your question. Please try writing it again.
So,
all right.
So you're saying, so Tom, an LLC can own a policy as one type of buy sell purchase agreement with life insurance. So if the members of the LLC change, how would that affect that? Is that in essence what he's asking?
Why don't I give you the exemptions of the transfer value? Because that's the biggest tax. A partner, right? The insured. Let's see. Geez, I almost forgot. Let's see. That would be the insured, the partner. I think the insured, if they're an officer of a corporation, others corporation can give it to the insured in a corporation. I that's the one thing I think an exemption. But anytime you give the policy back to either a partner, a partnership, or the insured, let's use those three, you have an exemption. You won't have a transfer for value. So the definition of transfer for value is Ed buys a policy on my life from the other partner, from Maureen. So Ed buys it on my life and we're not partners, okay? We're just stockholders in a company. Upon death, when the proceeds are paid to Ed, up to what he paid will be tax-free, but anything over that will be taxable income.
So I think this question was asked a little more succinctly. Can the LLC change ownership along the way?
As long as the ownership is there's a partner in the ownership.
Yeah.
Good.
Yeah.
These are great questions. I love these questions.
And we have another one about the tax implications, if we could go back to that subject. Specifically, what would tax implications be if the business is owner, partner insured, and insured spouse beneficiary?
Oh, well, that could be tricky, because if the owner of the is the company, you're saying they own the policy?
I believe so.
The owner of the policy, okay, right? And then the beneficiary is the spouse?
Yes.
Chances are it would be a dividend.
Right.
If you think about it, the company owns the policy. At death, it would normally come back to the company, but it went directly to the spouse. Now, the only thing close to that would be possibly a collateral split dollar, where the policy is funded by the company and they have a lien against the cash value up to the premium. The insured owns the policy and names his own beneficiary for the amount of insurance over and above the loan. So if I have $1 million policy and the company puts in $25,000 a year and they've done it for 10 years, at my death, they get 250 paid back for what they put the premium in, and the balance of the money goes to my wife. Because that's really a split dollar is really a individual policy. But when you have money going into the company, which they own the policy on, and then paid out to a non-employee, non-officer, whatever, I would call that a distribution. I think if it was an officer, it would be compensation. I think it would be taxable, though. I think I'm pretty sure of that. I know it won't be like a regular life insurance policy. The way to set that up, by the way, is have the company bonus to the employee who's the insured. Maybe it could be the owner, and make it his own policy, or set up a collateral split dollar insurance plan.
Right.
Someone's asking, would that not just be an executive bonus?
Yeah, exactly. Yeah. Terminology.
Yeah. Very good. So, Maureen, if I may, because I know
Yes.
people may have to start dropping off, and we appreciate the time. So I want to get to kind of the last question here, which is very important because we're talking about all of this, but it doesn't really matter if we don't really have someone with a pulse sitting across the table from us to talk to. We're nothing without somebody to talk to. So, Tom, Ed, what can you leave us with? You can call it a call to action or whatever you want to call it. How can we get in front of business owners? If we have business owner clients, how can we start these conversations with business owners? What can we offer them to pique their interest?
Good, Ed. First of all, Ed is good to know because the discussion of valuation perks ears up when you're an owner of a company. So valuation is one way to talk to it, and Ed can give you more light on that. And I'll come back with something else that I use.
Yeah, what do you got, Ed?
Yeah, I think the call to action we can provide is basically an independent review of either evaluation. If we were talking about an initial meeting with a business owner, I think it's really a discussion about, well, what's your perpetuation plan? I call the BSA, the buy-sell agreement, essentially a perpetuation plan because it addresses a lot of the trigger issues that we encounter in life. Divorce, as Tom said, all the dismal D's, if you will, that we encounter, and literally, we can offer a service vis-a-vis looking at the existing buy-sell as well as the existing valuation. And as a business advisor or as a financial advisor going in, I think the first question is, what is your perpetuation plan? Do you have a buy-sell agreement? If there is one, we have somebody that can take a look at it. There's somebody that can take a look at the valuation issues in the buy-sell as well as any valuation that was done as well.
Good. So you want to pique a business owner's interest with a valuation, no obligation valuation. Ed is there to help us with that. Is that fair, Ed?
Yeah, basically it will be essentially a consult meeting on a pro bono basis. Yep.
Good. Excellent.
And I might add, I use that a lot. He's been very good, generous with his time. I talk about that a lot and get Ed involved because people really want to know what their baby's worth.
Yeah.
That's one part of it. The other part of it is, a simple question of, what kind of plan have you made to extract your business equity at your death, disability, or retirement? And let them tell you what they've done. And because a lot of times they don't have an answer. And as you know, I like to use quick surveys because it undresses people. When I say undress, I mean a lot of people. If I said to you, Josh, how do you feel today? You say, I feel great, right? But I said, well, if I put a CT scan in front of you, would you feel as comfortable saying you feel great, not knowing what's inside, right? Because sometimes business owners only know what they know, but they don't know how to compare what they're doing versus other questions that would be posed. So my surveys get them to open up a lot about their buy and sell in their business in areas that they never thought about before. And that opens it up. So we open up a lot of discussions about it that way.
Good. So follow up with me, and we can answer any additional questions you had from today's roundtable. Also, if you are interested, I can get you connected with Ed on offering a consultation on valuations. I can get you connected with Tom to see how we can use the resources he just described in that survey to help you start having these conversations today. If today was overwhelming, or if you don't feel like you have all the expertise, you don't have to wait to start having these conversations. As Glenn said, we make all this simple. We want you to start having these conversations today so you can help these business owners. And just one or two of these cases, be it a buy-sell case, an executive compensation case, just one of the two of these cases will turn a good year into a great year because they are typically substantial when it comes to premium. So with that, we'll kick it off to Glenn just to give a couple more concluding words and resources that he can share.
Yeah, so here's Josh's contact information. If you want to click that, take a photo of that QR code, that'll take you to his contact info. You can easily put it in your V card in your phone. Feel free to give him a call or send him an email. He's always there to help. Also, can everybody see this? Okay, can you see that? Okay,
you're sharing your entire screen. Can you at least enlarge that window?
Stand by. Sorry, guys. Yeah. That's not what I wanted to do. Is that better?
That's much better.
Sorry, guys.
Yeah.
All right. Apologize for that. I'm sure that was painful. So yeah, so here's Josh's contact information. Now you can probably take a little snapshot of that QR code. There's his phone number, email. But I wanted to share one other thing with you guys. DMI licensed agents have access to what's called our My Back Office. So this gives you access to annuity pricing. You could follow up on your cases and all kinds of stuff in here. Client materials, sales kits, DIY campaigns, webinar resources that we can run for you or you can run on your own. Got a MIGA store, all of our partner programs. A lot to share. I'm not going to share all that. You can see all that in the left-hand side menu here. But what I want to point out is that we have a Business Insight Advantage program here that has everything from scripts and samples to help you make sales with business owners, initial conversations, retirement discussions, estate planning information, executive comp, business succession. But what we've also done is we've developed, with all the resources we have available, we've developed a business market guru that we call Winston. So we love Winston, and he's always on. He works 24/7. He doesn't have to eat. He doesn't sleep, and we'll help you with questions around estate planning, exec comp, business succession, valuation. That could at least help you become a little bit more comfortable with the topic, to where then you can, of course, always turn to Tom and Ed and Josh, but a lot of people find this to be a really great way to get comfortable with the topic. So that is available. I just wanted to make you aware of it. But the main point here is, though, that we'd love for you to continue the conversation with Josh. Again, the number here is 781-919-2325, jrem@dmi.com. And that, I believe, concludes the presentation for today, unless anybody's got any final words, but I think.
Yeah, I do. I always have a final word. I never out of word. Listen, a couple of things. If they want a copy of my ebook, or actually if they want a book of Unlocking Your Business DNA, they can go to Amazon and buy the Kindle or the paperback. I would suggest that if you want to be in the business market, it's 50 years of strategies I use with businesses that will help you out. But I'm going to make you buy it because the profits go to wounded warriors and veterans groups. I'd give it to you free, but I don't feel that nice. I don't feel like a nice guy today, so you're not getting it.
And what's the name again?
Unlocking Your Business. Yeah, I'm sorry. Unlocking Your Business DNA. It's on Amazon, Kindle, and paperback. It's a great book.
It is at that. And Tom, you're a great co-host. Love having you. You too, Ed, Josh, and Maureen. Thanks for helping out. Appreciate it. And yeah, everybody, feel free to follow up anytime. We appreciate you being here and look forward to seeing you on the next one. Everybody,
Thanks, everybody. Appreciate your time.